In this video, we delve into the ongoing debate of whether to buy or lease a car, a decision that often stirs controversy among consumers. The purpose of our video is to equip you with the knowledge needed to make an informed choice that aligns with your financial situation and lifestyle. Throughout the video, we will explore the various factors that influence this decision, including monthly payments, long-term costs, and the flexibility each option offers. Understanding the financial implications of purchasing versus leasing is crucial, as it can significantly impact your budget and overall financial health. Many people may not realize that the choice between buying and leasing can lead to surprising outcomes, particularly when considering depreciation, maintenance costs, and potential tax benefits. By analyzing these aspects, we aim to reveal insights that could challenge common perceptions and help you navigate this complex decision. Whether you are a first-time car buyer or looking to switch your current vehicle, our findings will provide valuable information to guide you. So, stay tuned as we break down the pros and cons of each option, ensuring you leave with a clearer understanding of what might work best for you in the long run. When it comes to purchasing a car, there are four main methods to consider: outright purchase, finance, lease, and personal contract purchase, PCP. An outright purchase involves paying the full price of the vehicle up front, granting you complete ownership from day one. This method eliminates monthly payments but requires a significant initial investment. Financing, on the other hand, allows you to spread the cost over a set period through monthly payments, ultimately leading to ownership once the loan is paid off. Leasing is a different approach, where you pay to use the car for a specified term without gaining ownership. At the end of the lease, you return the vehicle. Lastly, PCP combines elements of financing and leasing, offering lower monthly payments with the option to buy the car at the end of the term for a predetermined price. The key differences lie in ownership and payment structures. Outright purchase means full ownership immediately, while financing leads to ownership over time. Leasing offers no ownership, and PCP provides flexibility with an eventual purchase option. Psychological factors also play a role. Some may prefer the security of ownership, while others might enjoy the novelty of driving a new car every few years without the long-term commitment. Understanding these methods can help you make a choice that aligns with your financial goals and lifestyle preferences. Purchasing a car outright offers several significant benefits, primarily the advantage of full ownership and the absence of monthly payments. When you buy a vehicle outright, you eliminate the burden of ongoing financial commitments, allowing you to enjoy complete freedom with your asset. This means you can modify, sell, or use the car as you wish without any restrictions imposed by a lender or lease agreement. Additionally, owning your car outright can lead to potential resale value, as you retain the ability to sell the vehicle whenever you choose, potentially recouping a portion of your initial investment. However, it's essential to consider the opportunity costs associated with this method. By tying up a large sum of money in a car, you may miss out on other investment opportunities that could yield higher returns. For instance, if you spend $30,000 on a car, that money could have been invested in stocks or real estate, potentially generating greater wealth over time. Despite these considerations, purchasing a car outright can be financially beneficial in various scenarios. For example, if you plan to keep the vehicle for many years, the lack of monthly payments can lead to significant savings in the long run. Additionally, without interest payments or financing fees, the total cost of ownership can be lower, making outright purchase an appealing option for many buyers. Financing a car involves taking out a loan to cover the purchase price, allowing you to pay for the vehicle over time through monthly payments. Typically, this option requires a deposit, which is an upfront payment that reduces the total amount financed. The remaining balance is then paid off in installments, usually over a period of 3 to 7 years, with interest rates applied to the loan. Higher purchase financing means that the total cost of the vehicle can significantly increase due to these interest rates, which can vary based on your credit score and the lender's terms. At the end of the financing term, you will own the car outright, but it's essential to consider the total cost of ownership, which includes the initial price, interest paid, and any additional fees. This total can sometimes exceed the vehicle's market value, especially if the car depreciates quickly. Moreover, The potential resale value of the car plays a crucial role in assessing the overall cost of financing. If you decide to sell the vehicle after paying it off, the resale value can help offset the total expenditure. For instance, if you financed a car for $30,000 and sold it for $15,000 after 5 years, that resale value can significantly impact your net cost, making financing a more attractive option for some buyers. Leasing a car is a popular option that allows you to drive a vehicle for a specified period, typically 2 to 4 years, without the commitment of ownership. Unlike buying or financing, where you eventually own the car, leasing means you are essentially renting the vehicle for the duration of the lease term. This arrangement often results in lower monthly payments compared to financing, making it an attractive choice for those who prefer to drive a new car without the higher costs associated with ownership. However, while lower monthly payments are a significant advantage, there are potential drawbacks to consider. At the end of the lease term, you must return the vehicle to the dealership, and you will not have any equity in the car. Additionally, leases often come with mileage restrictions and fees for excessive wear and tear, which can lead to unexpected costs if not managed carefully. Understanding the lease terms and conditions is crucial before committing to this option. Key factors to review include the mileage limit, maintenance responsibilities, and any penalties for early termination. By being aware of these details, you can ensure that leasing aligns with your driving habits and financial goals. Ultimately, leasing can be a cost-effective way to enjoy a new vehicle, but it requires careful consideration of the terms involved. Personal Contract Purchase, PCP, is a flexible financing option that has gained popularity among car buyers due to its unique structure. With PCP, you typically start with a deposit, which is a percentage of the car's value, followed by lower monthly payments compared to traditional financing. These payments cover the vehicle's depreciation rather than its full purchase price, making it an appealing choice for those who want to drive a new car without committing to long-term ownership. At the end of the PCP term, usually lasting between 2 to 4 years, you face a crucial decision regarding the car's final value, known as the Guaranteed Minimum Future Value, GMFV. You can choose to return the vehicle, keep it by paying the GMFV, or trade it in for a new model. This flexibility allows you to adapt your choice based on your financial situation and preferences at the end of the term. Dealerships benefit significantly from promoting PCP options, as they encourage customers to return for new vehicles more frequently. This creates a cycle of repeat business, allowing dealerships to maintain a steady flow of sales. Additionally, the lower monthly payments associated with PCP can make it easier for buyers to afford a more expensive car, ultimately increasing dealership profits. Understanding the nuances of PCP can help buyers make informed decisions that align with their financial goals. To provide a comparative analysis of the costs associated with different car purchasing methods, we can use the Audi A3 as a case study. Let's examine the total costs over a 3-year period for outright purchase, financing, leasing, and personal contract purchase, PCP. For an outright purchase of an Audi A3 priced at $30,000, the total cost is simply the purchase price, which is $30,000. In contrast, financing the same vehicle with a 20% deposit, $6,000, and a 3-year loan at an interest rate of 5% would result in total payments of approximately $4,500 including interest. Leasing the Audi A3 typically involves lower monthly payments. For example, a lease might cost around $350 per month, totaling $12,600 over 3 years. However, at the end of the lease, you have no ownership of the vehicle. With PCP, assuming a similar deposit of $6,000 and monthly payments of about $400, the total cost over 3 years would be around $21,600, plus a final payment to own the car, which could be around $15,000. Calculating the total costs for each option is crucial for informed decision-making. Understanding these financial implications helps buyers choose the method that best aligns with their budget and long-term goals, ensuring they make a sound investment in their vehicle. When it comes to car purchasing decisions, psychological aspects play a significant role in shaping consumer behavior. One of the primary emotional benefits of ownership is the sense of pride and accomplishment that comes with having a vehicle that is entirely yours. This feeling of ownership can foster a deeper emotional connection to the car, as it represents a personal investment and a symbol of freedom. In contrast, leasing may provide a sense of novelty and excitement, allowing drivers to enjoy the latest models without the long-term commitment. But it often lacks the emotional satisfaction of true ownership. However, the stress associated with monthly payments can weigh heavily on buyers, regardless of the option chosen. For those financing or leasing a vehicle, the obligation to make consistent payments can create anxiety, especially if financial circumstances change. Additionally, ownership comes with maintenance responsibilities, which can be daunting for some. The burden of unexpected repairs or upkeep can detract from the joy of owning a car. Personal preferences also significantly influence the choice between purchasing and leasing. Some individuals may prioritize flexibility and the ability to drive a new car every few years, while others may value the long-term financial benefits of ownership. Ultimately, understanding these psychological factors can help you make more informed decisions that align with their emotional needs and financial realities. In this video, we emphasize the importance of understanding the financial implications of each method, as this knowledge can significantly impact your budget and long-term financial health. By analyzing the costs associated with each option, particularly using the Audi A3 as a case study, we highlighted how crucial it is to consider total expenses over time, including monthly payments, ownership, and potential resale value. Don't forget to subscribe to our channel for more financial insights and analysis. Check out this next video.